what kind of option trading do you do exactly, Harold?
I'm primarily a spread trader, so I like to sell premium and
Hmm.
using uh, put spreads, call spreads.
Okay.
So actually, so yeah, Harold, maybe let's start from the beginning on that. Just
Okay.
define what each of those are, and put it more into stock terms, I guess.
Okay. Well, when you say selling premium, that means you're taking in a credit,
Okay.
and it's a way of getting a little bit of income. So I like to sell premium, and when I say it's spread, you're selling you're selling in most cases a put. Well, if you're doing a put spread, you're selling a put
Okay.
and then you're buying a put. If you're on the call side, then you're selling a call or buying a call, or and then selling a call or buying a call. So it's on either, whether it doesn't matter if it's calls or put, it's a spread. So it's in the same cycle, expiration cycle.
Okay.
You're just using different strikes. It doesn't matter if it's puts or calls.
Hmm.
And so, like for the put, you're selling a put maybe at a higher price, and then buying the put a little bit lower price just to
Correct.
protect you from some kind of extreme kind of situation.
Correct. So a selling a spread, whether a call spread or a put spread, it's considered a risk defined trade.
Okay.
That's one another reason why I like these type of trades, because you know what your risk is going into the trade. So I already know how much I'm going to risk. That's one of the beauties of selling options is I know exactly what my risk is. So I say, okay, if this trade just collapses 2 seconds after I put the trade on, then I know what my risk is, and as long as I'm watching my position size, then I'll be okay.
Hmm. And just to again define some terms. So a call. What is a call?
Well, a call just it's a what most people are aware of. A call is it's a bullish strategy. So you can buy a call in the expectation that the stock is going to go up in price. So
Hmm.
and then buying a put is the opposite. So if you buy a put, you're expecting the stock to go down in price.
Right,
So
because with
that's
the call,
yeah. So that's the
yeah,
simplistic
yeah,
definition
you
of a
get the
call.
ability to buy the stock at a set price with the call, and with the put, you have the ability to sell stock at a set price. And of course,
Right.
when you sell a call, that's typically more bearish, right?
Right.
Because you're taking on the risk, the obligation of being that person that's going to buy the stock. And so it's almost like you're short, and you don't know how high up it can go. So as you said, selling a call is not risk defined, but you make it risk defined by buying that call to make sure you're protected, right?
Right. I call it you're buying it for protection.
Hmm. Hmm. And so, what you're talking about here, it seems like a lot of selling premium. So, are you just mostly into the credit spreads, or do you do the other side where you're doing debit spreads? And that's where a lot of times, for the credit spreads, you're the amount that you're selling is more than the amount that you're buying, and so you end up with a credit, right? And so,
Mhm.
do you do debit spreads as well, where you might be buying something at a higher price and the option that you're selling is
Yeah.
lower?
Yeah. Occasionally, I will do a debit spread, and I like to do it right at the money. So the at the money is basically the stock price. So if I do a debit spread, I like to buy one strike in the money and then one strike out of the money. Okay, and I do that occasionally, but I just prefer the selling the premium and taking in that credit there.
Hmm.
But
Hmm.
yeah, debit spreads, that is a strategy I will use, especially when volatility is low. When I
Right.
say volatility, I'm talking about the VIX. We look at the VIX as a measure of volatility. A few weeks ago, the VIX was right around 12,
Hmm.
which is extremely low, and that's when debit spreads tend to work a little bit better than your credit spreads. But over the last couple of weeks, we've seen the VIX go up. So um, options premiums have gotten a lot better the last week and a half, 2 weeks.
Hmm. Yeah. And so the VIX, of course, when we say volatility, that's specifically implied volatility, which is
Mhm.
looking, to the future. What is the expectation for a move? Now, it doesn't tell you direction. It just tells you, oh, the expectation is for a move of however much, as opposed to historical volatility, which is kind of, hey, you're just using the standard deviation, what's typical for it. So, so maybe get into this a little bit more when you're.
Well, and actually, before we get into that, Harold, what about time frame? Are you going out like a month, 2 months?
Extremely important.
Good point. Yeah.
One of the things I learned from John Carter is give yourself the gift of time. So when I'm looking at the options, I go to at least 45 to 60 days out. Okay. The zero expiration, the zero
0
DTE,
days to expiration, the zero DTE. Yeah.
I didn't even I heard about it. I haven't even looked into it. So don't ask me about zero DTE because, like I said, what I've learned is, you want to give yourself the gift of time. So when I'm placing an option trade, I want to be at least 45 to 60 days out just to give that option a chance to work.
Mm-hmm. Mm-hmm. Now, a lot of times people are talking about what's known as the volatility crush and how the implied volatility, when you're further out, a lot can happen, right? But as you get closer and closer to that expiration date, there is that time limit and less can happen, right? So the chances of it moving nearly as much, start going down. So that does make your option, option values less valuable. So
Right.
if you're selling premium, that works to your favor, right? So
Right.
how do you handle that as you get closer and closer to that expiration, and you might be having that benefit of the implied volatility going down for you?
So as time goes by, if you're selling premium, that time works in your favor. But I like to look at doing something with the trade at 21 days to expiration. So
Mm-hmm.
if I place a trade like we're right about in the November or December time frame, about 45 days out. So right now, if I look at the option chain, I'm going to go about 44, 45 days out. I'm going to do something or manage that trade once we get to 21 days to expiration. Once you get that close to expiration, there's not a whole lot of what's the term? There's not a whole lot of meat on the bone, so to speak,
Mm-hmm.
because you're that close to expiration. So, 21 days to expiration, that's when I'm looking to do something to trade, either lock in some profits. Maybe the trade is profitable, or I might roll it. Rolling is a way of just buying some time. Say the trade is not working for me, maybe I'm down on it. I can buy time by rolling it out to a further expiration, just to give myself some more time for that trade to work.
Mm-hmm. Right.
And so I guess maybe how do you take like IBD, right, and take kind of the stock picking from IBD and now execute it? So
Yeah.
how are you finding some of the ideas? Are you doing anything different from the stock picking for options versus just buying a stock?
Yeah, that's a question I've gotten many times over the years. People say, "Well, can I trade IBD stocks?" And yes, you can. A good option trade starts out with a good stock. And IBD, we've got good stocks, and regardless of what subscription you've got, you can find good stocks. So you want to have something that's liquid. Typically, stocks that are very liquid have good spreads, but not all the time. So you can find a stock that trades, let's say, a million shares on average. It's got a 50-day average of a million shares. But when you go look at the option chain, the spreads, the bid and ask, just might be too wide. So in that case, I just say, okay, I like the stock. I'm not going to do the option, but I will buy the shares. That's, like I said right at the beginning, I'm about 50-50 in with buying the shares versus trading the option, because there's been many times where I say, hey, I like the stock, but I do not like the options because the bid ask is just too wide.
Mm-hmm. Do you have a threshold there for if the bid ask spread is X%, I'm not going to do it? What's kind of your
Yeah,
rule of thumb?
10% is typically what I look at, but a lot of time I'll just eyeball it. I might do the numbers, plug in the numbers, and say, okay, well, what's the percentage difference between the bid and an ask? And what's typical is a 10%. But many times I'll just eyeball it, and then the smaller the difference between bid and ask, the better. The more liquid it's going to be.
Mm-hmm. And you mentioned rolling. So, uh, rolling is one of the things you can do when the trade isn't working. So when do you decide to roll versus I'm just going to cut my loss because the trade is going against me?
Yeah, yeah. Well, rolling, it's a somewhat of a controversial subject because you can get into some Jerry Springer type of arguments when it comes to rolling. And some people just think of, okay, when you're rolling, you're just kicking the can down the road. So
Uh-huh.
if you're down on it, just cut the trade and move on and look for something else. But typically, when I will look to roll a trade, especially, well, number one, if you're going to roll and you're doing spreads, you want to roll for a credit. Okay, if you have naked, meaning that you only sold a put or you sold a call or you bought a call, if you're naked, then you can easily roll for a credit to a later expiration. With spreads is a lot more difficult. And if the trade is going against me, then I immediately start looking to see, can I roll this trade for a credit to the future? So like if I put a trade on today, I might be looking into this to December to see, can I roll this trade to for a credit? And in most cases you cannot do it. So I just leave the trade alone. Occasionally I will roll it for a debit, but when you roll for a debit, that that increases your risk.
Mhm.
So I try not to roll for a debit, but sometimes it's a stock that I really like, or maybe I've come down to a level of support. Maybe the stock has declined. It came down to a level of support. I think it's going to come off support. I might buy some more time by rolling it into a later expiration just to see if this trade is going to work.